Last night, we got this confusing set of numbers from RH, the high-end home goods retailer that used to be known as Restoration Hardware. This story's been a bit of a roller coaster for years. 4 or 5 years ago, CEO Gary Friedman laid out some grandiose, sui generis expansion plans. He wanted to turn RH into a fun, full lifestyle brand with restaurants, hotels, yachts, and even a utopian real estate development in Aspen. The stock soared to the mid-700s at its peak in August of 2021 as the street became fascinated justifiably with the possibilities. But then the Fed hit us with a devastating series of rate hikes in 2022, and anything remotely connected to housing, well, it just got eviscerated. While RH quietly backed away from its most aggressive extreme plans, they kept aggressively expanding the core luxury home goods business, even in the depths of the downturn. The company had to pile on debt to make this happen, and the stock just sunk lower and lower. Basically, Gary Friedman made a big bet that his business could come roaring back once the economy turned around. 12 months ago, it looked like we were on the cusp of that kind of recovery. The Fed had started cutting interest rates, and there was a widespread sense that the housing market could indeed rebound. But then the bond market rebelled, the rate cuts stopped, and the Trump administration rolled out a very aggressive tariff agenda that devastated RH because they do most of their manufacturing in Southeast Asia, places that got hit hard on Liberation Day. This stuff's hard to build, expensive. Again, the stock was pulverized, falling from 249 to 149 in a single session. I checked in with Gary Friedman the next day, and he was optimistic about RH's ability to navigate the tariffs. Plus, those initial rates ended up being rolled back significantly over the next few months, which allowed the stock to crawl back from its lows. Unfortunately, RH got hit hard in September, ironically right as the Fed started cutting rates again after the 9-month pause. This time was because the company reported a weak quarter with a dismal outlook for the following quarter. And you know what? A slashed full-year forecast. Friedman seemed as confident as ever, but he was losing support from analysts and investors who previously had been giving him the benefit of the doubt because he is a genius. In the months since then, the stock drifted all the way back to the high 130s last month, not too far above where it bottomed in April. There was so much worry about the state of the consumer that nobody wanted to touch an incredibly high-end home goods chain. Of course, this stock's recovered over the last couple of weeks as Wall Street turned more positive on the consumer and more confident the Fed would continue to cut rates, which is exactly what happened 2 days ago. RH sat at $153 and change as of last night's close right before the quarter. And this time, the numbers were tricky to parse, although the stock eventually roared in response, finishing the day up 5.7%. Hey, very different from tech, huh? Why? First, RH's revenue came in a little better than expected, up 9% year over year, but its margins were soft, its earnings were pretty light, down 31% year over year, well short of the consensus. On the other hand, they delivered an excellent free cash flow number, $83 million. That was up from negative $96 million the year before, and that may be the best measure of the health of the company and why the stock ended up doing well. Unfortunately, management's forward guidance wasn't all that encouraging. For the current quarter, RH says it expects revenue growth of 7 to 8%, which is well below the 10% number Wall Street was looking for. Their margin guidance was real ugly, too. For the full year, management cut their profit margin guidance second quarter in a row. In his quarterly shareholder letter, which as always is incredibly entertaining, Friedman emphasized that RH is taking share all over the place and has industry-leading sales growth, even as this is the worst housing market in almost 50 years. In Friedman's view, his company's run roughshod over the competition. I happen to agree. Still, even if they're fine on the revenue front, they've got a real problem on the margin front. Friedman blamed this one, quote, on higher than forecasted tariff expense and, quote, higher than expected Paris opening expenses. The former is self-explanatory, and the latter has to do with the company's expensive European expansion plan that he thinks is really just a flag planted large. Of course, in the conference call, Friedman had nothing but positive things to say about the gorgeous new location. It's a destination, and like many of Gary's other properties, the Paris property is like nothing you have ever seen. I mean, look, I jotted it down. I got to go see it, that kind of thing, as I've done with other ones of his great properties. There was also plenty of talk about risk on the call, with Friedman citing the still pretty awful housing market, the highly disruptive tariff situation, and the fact that construction costs have risen significantly since the pandemic. He says that this is, quote, not a time to underestimate risk, end quote. Still, he followed that up immediately by saying, quote, well, not a time to underestimate risk, also not a time to run from it, end quote. He added that RH is, quote, building an iconic global selling platform that will likely never be duplicated in our times, end quote. He's right. Now, there are a few people who are better at shameless self-promotion than I am. But even I can't compete with Friedman. That's it. I don't. Have you heard about my new book, How to Make Money? It's in all the bookstores. All right, I kid. But the fact is, Wall Street loved this update from RH. Initially, stocks sold off in after-hours trading, then spiked up 14% before cooling off again. This one's a wild trader. Unfortunately, it finished today up ultimately it finished today up 6%. I thought that was pretty darn good because there were a lot of companies that really did not do well after the quarter today. Now, look, not everyone's sold on the idea that this was a positive quarter. Here was a curious one. Analysts at Stifel downgraded RH in response, saying they still believe there's a fundamental mismatch between the company's valuation and its long-term prospects. They just don't see what kind of catalyst could be coming to help close that mismatch. How about if housing got better? So here's where I come down. At the end of the day, RH remains what has been a highly levered way to play a potential housing recovery. If we get some more relief on interest rates, meaning if the Fed stays friendly, then housing can rebound and RH will be a home run over the next couple of years. If you believe there will be a turn in housing, this could be a fantastic stock. But if the housing market doesn't materially improve and the company continues to be rocked by tariffs, and Gary Friedman keeps forging boldly with his expansion strategy, even if market conditions don't really warrant it, well, then some very, very bad self-inflicted outcomes could be on the table. The bottom line, RH is high risk, high reward. But it really comes down to how you feel about housing. Either way, though, I know it's going to be an entertaining ride. A classroom full of ideas from a driven professor of lifestyle, galleries, and the human mind. Let's go to Rich in Texas. Rich.
Hey, Jim. Hey, with interest rates killing builders and suppliers, but not diminishing the housing shortage, with the current PE of 20 in an environment of low demand, is Builders First Choice poised for explosive growth to 150 with the next rate cut?
I was a huge believer in Builders First Source. This is proving to be such a hard market that I had to default and switch to Home Depot and Lowe's. Builders First Source is a moonshot. It could be unbelievable. I want to take a little bit of the risk off the table, which is why we bought Home Depot for the Charitable Trust. I, too, want to be involved in exactly what you just said. But I've known Home Depot for much longer, and I'm much less worried about it. And that's what you have to be. You have to be much less worried about something connected to housing today. Home Depot up a couple bucks again. Let's go to Mark in Iowa. Mark.
Hi, Jim. I'm thinking about adding a REIT stock for the dividends to go with the 7 other stocks I put on my watch list today. Thank you. It's a REIT that's sitting around about in the middle of its 52-week range right now. It's at a 10.39% yield. The CEO has stated before that lowering of interest rates would really be a boon to all the REITs. And with a little room to go up in this stock, is it time to add Starwood to my watch list?
Okay, this is a tough one for me. I think the world of Barry Sternlicht. It's got a 10% yield, which is pretty terrific. I want Barry to come on and tell me what's in the portfolio so I would feel better recommending it, because I was quite surprised that it could have such a precipitous fall, given how good Barry Sternlicht really is. Thank you for the call. All right. How you think RH will do all comes down to how you think the housing market will do. If you believe in a housing turnaround, I think that you should also believe in RH. So much more Mad Money ahead. I'm hearing more of your market questions and give you an inside look at what we do for the CNBC Investing Club every month. Then rotation days like today can throw investors out of the game, but not if you make sure to keep this one investing mantra in mind. I'm telling you what it is after the break. Of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.